Hey, good afternoon. We're visiting with Taylor Ducoff, Executive Vice President of Commercial and Industrial Lending at Cadence Bank. Taylor, thank you for your time today to discuss some very interesting times in the world of finance.
Yeah, thank you for having me.
And our discussion today is quite timely with all the news and in the financial sector. And speaking of that, for those who don't know, regulators recently seized control of Silicon Valley Bank operations due to mismanagement over their deposit reserves, which led to the second largest bank failure in U.S. history behind Lehman's of 2008. Taylor, I understand that Silicon Valley Bank had heavy exposure to venture capital funds tied to investment in the tech sector, exposing them to high-risk new technologies with a long payback. How does that profile compare to investing in the energy sector, especially where we're considering new technologies to drive a global energy transition?
Yeah, really the biggest difference of a Silicon Valley versus banks that most people are familiar with, they had an extremely high concentration of large depositors. I think, their insured deposits were below 5% of their total deposit base. Typical bank would be, 50 to 70%. And that was really a product of the fact that they weren't really targeting consumers or small businesses. They were really going after larger venture capital backed companies, like you said, in the technology space. So really the thing that got them in trouble, was some balance sheet mismanagement, coupled with the fact that their core deposit base was made up of companies that really burn cash as opposed to build or hold cash. So if you look at a normal regional or even large commercial bank, it's a very stable deposit base, doesn't move around a whole lot. Their whole deposit base was built off companies that burn cash, and the only way they built it was generally by raising capital, which has slowed down quite a bit. So you couple that with the balance sheet mismanagement that they had, and that's why things turned so quickly for them.
Yeah, that's interesting. I understand that it was vastly different from what we saw in 2008 with the real estate loan exposure. I'd heard that it was a deposit situation, so that's quite interesting. Let's consider inflation for a moment, which seems to have a stronghold on our economy. As the Fed continues to increase interest rates to temper inflation, how is the industrial sector navigating this higher cost of capital?
It's a great question. Some better than others, right? One thing that we saw over the last 18 or 24 months, a lot of companies entered some sort of an interest rate hedge, either through a cap or a swap with a derivatives group. We did that for a lot of customers. Obviously, the ones that did that are pretty happy with that today. Those that did not, you only really have a couple of options, right? You can only push banks so far on the rate that they'll go on. So, companies will use more cash. They may slow down on, purchasing certain things. We kind of see a variety of that right now. The good news is that, in the sector that BIC covers and that we bank a lot of companies in, that sector is performing exceptionally well, right? And so the reality is that revenues are growing, margins maintained pretty good, and so they're still able to handle a higher interest burden, still beneficial for the business to continue to grow, continue to buy that equipment. So we've seen strong growth in our loan portfolio in that space, and they've managed it fairly well.
Does legacy performance, for a moment, just to ask this question, does legacy performance come into play as well? Because rather than a high-risk tech adventure or tech venture where you don't know the outcome, you have legacy performance built into the history of this sector. So you have a little bit more knowledge of those outcomes or can predict those outcomes. Does that come into play at all?
100%. I mean, in general, it's going to garner, easier underwriting for banks. And that's going to result in lower interest rates, right? I mean, rates are going to be higher for the companies, but if you compare that to other industries where you don't have that track record, you're going to end up paying, a premium for that risk that banks are going to take. Right. If you can, get the approval for the loan at all, right?
Yeah. So talking about all these factors, these seem to really be complicating investment banking and finance. What are some of the keys to picking the right bank as a business partner?
I take a pretty simple approach to it. You pick a bank partner the same way you pick any other business partner, right? I think that right now people are and should be asking questions on the financial strength of any bank that they're looking to do business with. A lot of banks are public, some are not, but they're willing to share that information with you and show what their capital ratios look like. So that's an easy question to ask that maybe people haven't in the last 24 months. And then aside from that, you're looking for people, hopefully you've got a relationship with them. Hopefully you can trust them and you've got some sort of history or reference where you know that they're good operators of their own business, right? It's been a while since people really worried about that, but it does matter. The historical, thing that people were looking for in banks was purely if they could get the loan that they wanted and if they thought that the customer service would be good. I think now banks have a little bit more, responsibility for us to prove to our prospects and customers why we're strong and we're a good partner for them long term. So I think it's asking some of those questions early on, making sure that you feel like you're aligned with your company and the bank on their risk tolerance, and building that relationship on a number of fronts.
Yeah, key questions to build in, like you said, in relationships and in building that partnership. So speaking of partnering, let's explore merger and acquisition activity. Cadence has participated in many substantial industrial M&A transactions. Can you portray Cadence Bank's role in M&A activities?
Sure. As a bank, we do a lot of it. I would say we do an outsized amount of kind of M&A type financing for a bank our size. That's just given some of the legacy, executive leaders that we have and how our bank was founded. We take a very partnership approach. I think the thing that we do really well, we're responsive, we have good customer service, and we've been very consistent from a credit perspective on what we do in the markets that we serve. So I think of, the customer base of BIC. It's a market that we've served for many, many years. We've never, we're not new to it, right? And we feel like we understand it. So I think that when we look at M&A, a lot of times, whether it's buyer or even seller coming to us in that, they can count on us for quick feedback of what the market looks like. Hopefully that's something that they decide to pursue with us, but if not, we give them the best read we can on what the market is for leverage levels and pricing and things like that. So not to oversell it, but we like to view ourselves as a little bit of an advisor to companies during the M&A process, as opposed to purely just the debt side.
Right. So as we take a look back at recent events, just in recent days, actually, and then looking at markets as they develop, certainly in the energy market, what's the horizon view for Cadence Bank relative to the industrial finance?
We love the backdrop of the industry, right? Despite any political headwinds you read about or kind of the resurgence in renewable space, the reality is at its core, the industrial sector has an enormous labor force of skilled workers, and we're in growing parts of the country, and it serves a global market. So we don't see anything that's going to slow down the industrial sector. We think, frankly, that we'll likely diversify, right? So if we look at our customer base and their customer base, behind that, it's going to continue to diversify a lot. We're already hearing about companies that are served, that have historically serviced petrochem, now doing some renewable facilities. So we think that that's an easy transition. So we're very bullish on the industry as a whole. We like all companies in the space. We've particularly focused on specialized businesses that provide services that are really mission critical for, the refineries and the petrochem facilities. So our outlook continues to be very strong, very much open for business in space, and excited to continue to service our clients and look for deals.
That's exciting to hear. We feel the same way. There's a lot going on, that's for sure. We're just scratching the surface here, and I find this fascinating, and it's wonderful to meet you, Taylor. It's been a pleasure talking with you today. If viewers would like to reach out for more information, how can they get a hold of you or someone at Cadence Bank?
Sure. So you can give me a shout, shoot me an email. Phone number is readily available, can share it. It's also, we're active advertisers in BIC Magazine. We've got our information there. I believe it's my personal information. So anytime anybody may have a question, please do reach out.
Fantastic. And we'll put everybody in touch, connect everybody in business and industry for everybody's good, everybody's benefit. Taylor, look, it's great meeting you. Thank you for your time today. And thank you, everybody, for watching. Thank you very much.
Thank you.